Imagine waking up on a Monday morning with the global financial world holding its breath, oil prices surging, economies grappling with reserve challenges, a potential carry trade unwind, threatening to send trillions flowing across borders in a hurry, and the traditional banking infrastructure that's supposed to handle all of that creaking under the weight. That's not a hypothetical. That's right now, March 30th, 2026. And the domino theory that XRP holders have been discussing for years is no longer just a concept, it's unfolding in real time. Because here's what most people don't connect. The same macro pressures that are creating chaos in traditional markets are the exact conditions that XRP was designed for. When systems need fast, on-demand liquidity, when capital needs to move across borders instantly, when the old rails can't keep up with the velocity of global financial stress, that's when the infrastructure Ripple built stops being a nice-to-have and becomes a must-have. This is not financial advice. I'm sharing analysis, observations, and insights based on publicly available information. Always do your own research and make decisions that are right for you. Before we get into the full breakdown, drop domino in the comments if you believe the macro pressures are about to accelerate XRP adoption. Drop noise if you think the global volatility is just temporary chaos that won't impact crypto fundamentals. I want to see where this community reads the situation. Welcome back. I am the Calm Analyst. Around here, we connect the macro dots to the micro positioning. We trace how global events create the exact conditions that validate the infrastructure being built around XRP. Today, we're going deep on the oil shock dynamics, the carry trade unwind risk, the regulatory breakthroughs stacking up in April, and why these forces converging simultaneously could be the catalyst that turns years of patience into the momentum holders have been waiting for. Let's get into it. Let me start with the macro picture, because the global backdrop right now is not random noise. It's the exact kind of pressure that tests whether the infrastructure built for moments like this actually works. Reports are swirling about countries like Japan and Australia edging closer to real strain on their energy reserves. Middle East tensions and shipping disruptions are pushing oil prices higher. And those pressures don't just create market headlines, they amplify the need for fast, on-demand liquidity when traditional systems start struggling under the weight. Think about what happens during an oil shock. Countries that import energy need to pay for it. Those payments happen across borders. They happen in different currencies. They need to settle quickly, because commodity markets don't wait for correspondent banking relationships to clear over 2 to 5 business days. The current system handles this through pre-funded nostro accounts. Banks sitting on $1.8 trillion in idle capital around the world just to guarantee that cross-border payments can settle. Capital that earns nothing, just sitting there waiting. Now think about what happens if a carry trade unwind hits simultaneously. The yen carry trade has been funding leverage positions worldwide. With Bank of Japan policy signals shifting and oil-driven inflation pressures building, any unwind could send trillions flowing back across borders in a hurry. That's exactly the kind of rapid repatriation that traditional banking rails struggle with. And that's exactly what XRP was built to handle. No pre-funding, no idle accounts, instant bridging that settles in seconds. The on-demand liquidity mechanism doesn't need $1.8 trillion sitting in nostro accounts. It needs a bridge asset that can convert between currencies in real time at fractions of a cent per transaction. Community discussions are already lighting up with this connection. Posts pointing out how an oil shock or reserve depletion could force the kind of rapid cross-border capital movement that traditional rails struggle with, but XRP handles effortlessly. One analyst even floated the idea of tokenizing oil itself on the XRP Ledger, which would be transformative for commodity markets needing instant transparency and movement. If that macro connection just clicked for you, the idea that global financial stress doesn't threaten XRP but actually validates its existence, smash that like button. This is the analysis that connects the world economy to your position. One tap helps it reach the next person who needs to see these connections. Now let me layer the regulatory breakthroughs on top. Because the macro pressures would mean nothing without the legal framework to let institutions actually use XRP. On March 17th, the SEC and CFTC came together to officially classify XRP as a digital commodity, binding federal classification. Same category as Bitcoin and Ethereum. That cuts through years of uncertainty and positions XRP squarely alongside assets that institutions can actually work with at scale. And layering on top of that, the Office of the Comptroller of the Currency is rolling out revised rules on April 1st that expand what national trust banks can do with digital assets, including non-fiduciary activities that play directly into Ripple's wheelhouse. Ripple has already secured conditional approval for its own national trust bank charter. That means we're not talking theory anymore. We're talking a federally regulated pathway for custody, settlement, and liquidity services that could plug XRP directly into the heart of traditional finance. The same traditional finance that's about to face liquidity stress from the macro pressures we just discussed. The Clarity Act markup is targeting the second half of April. The Senate Banking Committee is back from recess on April 13th. Garlinghouse predicts passage by end of May. Polymarket has it at 72%. The bipartisan language exists. The White House endorsement exists. Think about the timing. Global liquidity pressures building, regulatory clarity landing, institutional infrastructure activating, OCC amendments going live, all in the same 60-day window. These aren't coincidences. They're the convergence that turns the domino theory from concept into reality. Comment below. Which macro event do you think tips the first domino for XRP? Type oil if you think energy prices drive it. Type carry trade if you think the yen unwind is the trigger. Type Clarity Act if you think regulation is the catalyst. I want to see which force this community is watching most closely. Now let me connect the institutional momentum, because the partnerships stacking up in 2026 are not getting the attention they deserve. Deutsche Bank integrated for cross-border FX flows. Aviva investors tokenizing funds on the XRP Ledger. Societe Generale launching its Euro stablecoin on the XRPL. Australia's AUD stablecoin getting full licensing as the first government-backed stablecoin on the Ledger. Over 100 national banks already testing the Ledger for efficiency. Ripple Prime added to the DTCC's NSCC participant directory with clearing and executing broker credentials. MasterCard's $9 trillion network integrated. Swift's framework going live with 50-plus banks by June, with 30 being Ripple partners. And yet the price hasn't reacted, which is exactly the kind of disconnect that creates opportunity for those paying attention. Smart money isn't chasing headlines. It's positioning for the utility layer that kicks in when volatility from macro events like oil spikes or carry trade unwinds hits. The swell event buzz adds fuel. Lineups featuring White House digital asset advisors, NASDAQ leadership, BlackRock's digital assets director, JP Morgan executives. These aren't casual panels. They're strategy sessions on tokenization, stablecoins, and cross-border rails, where XRP's escrow and burn mechanics provide the predictable supply dynamics that institutions crave. The smart money isn't waiting for perfect conditions. They're building the rails now, knowing that events like potential carry trade reversals could accelerate everything. And when the macro pressure hits and the traditional systems show their cracks, the infrastructure that's already in place captures the flow. Now let me talk about XRP's core mechanics. Because in a macro stress environment, these features become more than technical details. They become the reason institutions choose XRP over alternatives. Transaction burns. Every move across the XRP ledger reduces supply ever so slightly. At current usage levels, the impact is minimal. But as volume ramps with institutional use during liquidity crunches, the deflationary pressure becomes meaningful. Supply shrinks precisely when demand increases most. Escrow mechanisms. Controlled releases that prevent dumps and build institutional trust. Up to 1 billion XRP released per month, with 60 to 80% historically relocked. Predictable supply dynamics that compliance departments can model and plan around. Fixed total supply, 100 billion XRP, hard capped, no inflation, no dilution from new issuance. In a world where central banks are printing money and currencies are losing purchasing power from oil-driven inflation, a fixed supply bridge asset becomes more attractive by comparison. And now the zero-knowledge proof DNA protocol for private yet verifiable KYC on the ledger, showing a mature approach to balancing privacy with compliance, not hiding from regulation, enabling real adoption without the usual friction. Contrast that with Bitcoin maximalists who frame everything through the digital gold lens. Fair enough for store of value, but they miss how XRP's role as a bridge asset in a tokenized world addresses actual pain points in global finance that gold or even Bitcoin alone can't touch. When a bank needs to move $500 million across borders in seconds during an oil crisis, they don't need digital gold, they need digital plumbing, and XRP is that plumbing. Subscribe right now, hit the bell, drop a bucks in the comments, because April is when the dominoes start falling. The OCC amendments go live April 1st. The Senate returns April 13th. The Clarity Act markup targets late April. The Goldman Sachs Q1 filing lands in May. The SWIFT framework launches in June. Every week we track these catalysts in real time with the macro context that tells you why they matter. Now let me address the psychology, because I know what many of you are feeling. The market compression around $1.30 to $1.40, the fear and greed index at extreme fear, the comment sections filled with doubt, the frustration of watching every good headline land while the price stays flat or drops. I've watched enough cycles to know what this feels like, and I've watched enough cycles to know what comes after. The moments when doubt peaks are almost always right before the structural shift, the compression before the release, the tree being shaken one last time while the roots grow stronger underneath. The historical parallels are striking. In past cycles, similar macro squeezes preceded breakout moments for utility-focused assets once the infrastructure was in place and clarity arrived. The dot-com shakeouts, the early crypto cycles. Every time, the pattern was the same. Painful compression, maximum fear, then the catalyst hits, and everything that was building underneath becomes visible in the price. Right now, with XRP navigating post-ETF decision volatility, absorbing the commodity classification without a sustained move, holding steady through macro headwinds, it's echoing those historical setups. Whale movements and institutional accumulation are ramping up precisely around these liquidity themes, countering the FUD from those who only see the short-term dips without the long-term utility arc. The psychological edge for holders who understand the macro connection is enormous. Instead of panic when oil prices spike and markets sell off, you see the very conditions that validate XRP's existence. Instead of fear when the carry trade threatens to unwind, you see the scenario that the on-demand liquidity system was built for. The chaos that terrifies most investors is the opportunity that XRP was designed to capture. Let me bring this all together, because the domino theory isn't abstract anymore. First domino, global macro stress from oil prices, energy reserves, and carry trade dynamics creating urgent demand for fast cross-border liquidity. Second domino, regulatory clarity landing simultaneously, commodity classification done, OCC amendments going live, Clarity Act advancing, federal bank charter pathway open for Ripple. Third domino, institutional infrastructure already embedded, DTCC directory, SWIFT framework, MasterCard integration, 300 banks across 45 countries, over 100 national banks testing the ledger. Fourth domino, supply mechanics tightening, transaction burns reducing supply with usage, escrow relocks preventing floods, ETF custodial lockups removing float, whale accumulation absorbing retail selling. Fifth domino, price repricing, institutional flows arriving 6 to 12 weeks after the regulatory catalysts land, stepped repricing events as each catalyst window produces a floor that doesn't give back. Each domino makes the next one fall faster. The macro stress creates the demand. The regulation gives permission. The infrastructure provides the rails. The supply mechanics amplify the price impact, and the repricing follows, lagged but inevitable. The people positioned at the front of this chain are not the ones who waited for confirmation. They're the ones who understood the dominoes before they started falling. In a tokenized economy where bank deposits, real-world assets, and even commodity settlements move on-chain, the opportunities for those who positioned early aren't incremental, they're generational. XRP's model, with its focus on efficiency and compliance, stands out against hype-driven projects that burn out when the spotlight fades. Ripple's own leadership points to scaled institutional rollout throughout 2026, with significant Fortune 500 engagement with the XRP Ledger. That's not speculation. That's backed by the partnerships, the regulatory green lights, and the macro conditions all aligning in the same window. Price is a distraction. Value is the reality. Structure is what matters. And the structure being built around XRP right now, regulatory, institutional, technological, and macroeconomic, is the most comprehensive convergence of forces this asset has ever seen. In a market fueled by emotion and noise, we thrive on data and composure. Remember, haste leads to loss, while calm analysis leads to victory. If you made it to the end, you now see the full domino chain. The macro pressures creating demand, the regulation giving permission, the infrastructure providing rails, the supply mechanics amplifying impact, and the timeline putting it all in the next 60 days. Comment, "Calm analyst," below. Let me see who stayed for the complete breakdown. And share this with someone who's been watching the global news with anxiety instead of seeing it as the validation of the XRP thesis. They need to see how the chaos connects to the opportunity. Like, subscribe, notifications on. I'll see you in the next one. Stay patient, stay rational, and as we always do, we don't wait for the future, we plan for it. Peace.